What if you could make one investment decision, one, and then just get paid? Not managing it forever, not monitoring it, not logging into some app every single morning wondering whether to buy, sell, or panic. I'm talking about one decision, and then the money shows up every single month. That sounds too good to be true, and most of the time it is. Most of the things people call passive income are just different work wearing a better name. But there's one version of that actually delivers on the promise. And by the end of this video, you're gonna know exactly how it works, what it takes to set it up right, and why once people find it, they can't believe nobody ever showed it to them before. I'm Adam Williams, founder of Elevest Capital. Last year alone, we did over $200 million in multifamily transactions, and I added over 1,300 units to our portfolio. 20 years in, I've tested almost every version of passive income that exists. And here's what I found. The honest test, let's be honest about something first. The term passive income has been ruined by people selling courses about passive income, every side hustle, every drop shipping store, every time I made $10,000 last month video. All of it gets labeled as passive income, but almost none of it actually is. Here's the test I use. If you stop paying attention to it tomorrow, completely ignore it for 6 months, would it still be producing income for you? Let's run that test. A stock portfolio. Stop watching it. Stop rebalancing it. Would it keep producing? Sort of. Dividend stocks. They throw off a little income, but you'd be missing out on the rebalancing opportunities and making worse decisions by the time you came back. Not truly passive income, in my opinion. Crypto. Ignore it for 6 months in a volatile market, and best case, you got lucky. Worst case, you missed a 60% drawdown that you could have managed. Not passive, not even close. Short-term rentals. Stop paying attention to your Airbnb for 6 months, and you'll come back to bad reviews, unmanaged maintenance, and a tanked ranking. And that's a hospitality business, not an investment. Dividend stocks, better than most, but you're still making decisions about which stocks to hold and how to manage the tax drag. Not nothing, but not set it and forget it either. Most things people call passive income require ongoing attention to keep working. The moment you stop paying attention, they stop producing or start declining. There's one exception, and it's the one nobody talks about at dinner parties. What true passive income looks like. You write one check, a professional operator takes it from there, they find the deal, negotiate the deal, secure the financing, assemble the team, they have the management infrastructure, the systems, and the track record. You review all of that before you wrote your check. We'll get to that part in a minute. And then you made your decision. That's the last active decision you make. Every month after that, a distribution hits your bank account. You didn't do anything to earn it that month. You didn't manage anything, monitor anything, make any decisions. You just own a piece of something that keeps producing. And the professionals running it send you your share every 30 days. No app to check every morning, no decisions about holding or selling or rebalancing, no tenants calling you, no maintenance to coordinate, one decision, then money. That's truly passive income. Multifamily real estate investing, it's the closest thing where you invest once and you profit forever that I've ever found. Now let's make this real for a minute. Let's say you invest $200,000 as a passive limited partner in a professionally managed multifamily deal. Within 30 to 90 days of closing, your first distribution arrives. Not at year end, not when the property sells, within the first few months of ownership. And at a 4% annual cash-on-cash return, a conservative target for a well-structured deal, that's $8,000 a year or $667 a month every single month for the life of the hold, which is typically 3 to 7 years in most deals. You made one decision, reviewed the deal, verified the operator, signed the docs, wired the money, and $667 shows up every single month without you lifting a finger. And at exit, when the property sells, you receive your share of the equity upside. On a deal that executes well, that payout can be significant on top of everything you've already collected. Then it gets even better. Are you ready for this? If you decide to roll those proceeds into the next deal, now you're deploying more. The monthly distributions are larger, the equity upside at exit is larger, 2 decisions total, and the machine got bigger. That's the flywheel. And once it's running, it takes almost no ongoing effort to keep it going. Let me take a quick pause for a second. If this is resonating with you right now, and I certainly hope it is, and you want to be around other people that are actually doing this, not just learning about it, come join our free community. It's called the More Club. You can go to school.com/More Club. It's completely free. Hundreds of real estate investors are in there every day sharing deals they're working on, helping each other move faster. The link's in the description. You can just join anytime you want. Now back to the strategy. Most people think of passive income as destination. You hit a number and then you're done. I think about it differently. It's an engine, and engines compound over time. In practice, this is what it looks like. Year one, you invest $200,000, you collect $667 a month, you reinvest some of it into the next deal. Year three, the first deal exits, you collect the equity upside and you roll the full proceeds into a larger deal. Now you're invested at $300,000 to $400,000 and your monthly distributions grow. Year five, the second deal exits, larger proceeds, larger reinvestment, larger distributions. You didn't get smarter between year one and year five. You didn't work harder or make more complex decisions. You let the flywheel run like it's supposed to. The lazy millionaire isn't someone who avoids work their whole life. They're someone who did the hard thinking once, found the right vehicle, found the right operator, deployed the capital correctly, and then got out of the way and let the machine compound. That's the strategy. It's genuinely that simple. Now, I want to be completely honest with you about one part of this. The lazy comes after the diligent, not instead of it. Before you write that check, you do your homework. Not because the investment is complicated, but because who you invest with matters enormously. The operator is the whole game. The deal structure is the whole game. Getting those two things right is what earns you the right to be completely hands-off for the entire next 5 years. That homework looks like 5 questions. Ask them directly and listen carefully to the answers. What's your average LTV? How's the debt structured? Do you underwrite on current rents or projected rents? What markets are you in and why? And how do you communicate with investors when things don't go exactly as planned? And get direct answers to every one of those with specifics, not just vague reassurances. Specific numbers, specific structures, specific reasons. That one honest conversation before you invest is the piece of admission to 5 years of hands-off cash flow. So just pay it. It's worth it. Now here's the bottom line. The lazy millionaire strategy isn't about avoiding work. It's about doing the right work once, finding the vehicle, the right operator, making the right initial decision, and letting that decision compound for years without asking anything more of you. Most people never find this because they're too busy chasing the exciting plays, the stocks, the crypto, the flip, the Airbnb. All of them promise passive income. All of them quietly demand ongoing attention. This one actually delivers. One decision, monthly income, equity upside at exit, no ongoing effort required. The only question is whether you're ready to make that one decision that starts it. Knowing the strategy is one thing. Knowing how to truly evaluate a deal before you wire the money is another. And that's actually where most people get this wrong. Not the strategy, but the diligence. I broke down exactly how to evaluate a passive multifamily deal, what to look for, what to avoid in a video I linked below. And that video, plus the free community I mentioned earlier, are linked in the description below as well. I'll see you there.